Hello friends, welcome back to Market Academy. Today we will talk about a book, The Intelligent Investor, written by Benjamin Graham, which was first published in 1949. Graham was an American economist and professional investor. Graham is considered as first ever value investor. Warren Buffett, who is very famous investor, credits Graham with for teaching him investment framework, and considers him most influential person after his father. With the help of arguments, examples, and practical principles, the intelligent investor has, towards the investment decisions of the readers, created a mental and emotional attitude. You will get to know that with minimum efforts and capability also you can get better results. If you haven't yet subscribed to our channel, then before you are lost in the video, immediately subscribe the channel, and also like the video immediately. By joining our channel, you can get benefits of all stock market related updates. Our channel is one of the best summary channels on YouTube. Our videos can sometimes be little longer, because we never compromise on the content of the video and book. Therefore it's important to watch the video till the end. One more book, Rich Dad Poor Dad, written by Robert T. Kiyosaki and Sharon Lechter. This book is about, the overarching theme of Rich Dad Poor Dad is how to use money as a tool for wealth development. It destroys the myth that the rich are born rich, explains why your personal residence may not really be an asset, describes the real difference between an asset and a liability, and much more. Video link is given in the description. You can watch the video and subscribe and support our channel. The main objective of the intelligent investor is to give information on successful investment policy to a common person and executing it successfully. Those who every day invest in the market, this book isn't for them. Neither its objective is to teach you to beat the market. This book can help those a lot who want to learn about the investing from the beginning. This book is divided into 3 different parts. First, who is an intelligent investor? And after that, defensive and enterprising investor, i.e., aggressive investors are explained in detail. So let's begin. Who is an intelligent investor? Let's start with the most important question. Who to invest? Because of inflation, this destroys our wealth almost 3% a year. And it's very easy to observe this. When inflation rate increases, then people depending on a fixed income will suffer a lot. Almost every year. On the other hand, those who invest regularly, even during the inflation, get support from dividend and investment portfolio value. So what Graham means by intelligent investor? It simply means that stay calm and disciplined, and be eager to learn. You should control your emotions and think about yourself. No matter how careful you are, your investment value will drop from time to time. You cannot remove this risk. You can only manage it and control your fears. In other words, biggest problem and enemy of investors are they themselves. Therefore you have to emphasize on 3 things. How to reduce the unrecoverable loss, how to increase sustainable gains, how to control self-defeating behavior that doesn't let most investors reach their full potential. The first principle an intelligent investor has to learn is that the increase in stock price increases the risk, and decrease in stock price decreases the risk. An intelligent investor is afraid when market goes up, because due to high price, then it's difficult to buy the stock, while you should welcome the downward market, because now the stocks can be sold again. Here the margin of safety concept of Graham hits. By not putting too much money for an investment, your risk of wealth destruction can be reduced. It's important to notice that Graham has used the word investor with speculator also. Those who invest earn for themselves, and those who speculate earn for their brokers. Investment gives right returns with safety. An action that doesn't fulfill this requirement is like speculation only. We will talk about 2 types of investor next. The defensive investor, also known as passive investor. They avoid big mistakes and losses, and focus on freedom from continuous efforts, troubles, and need to take decisions. The enterprising investor, also known as active or aggressive investor. They like to use their time and focus to select securities, which are more attractive than average. Also, their average returns are more than passive investors. It's wise to buy high-grade bonds. So is buying different types of leading common stocks than any investor can do with minimum or no help of an experts. Let's understand in details these 2 types of intelligent investors. The defensive investor. A defensive investor, even while sitting still, runs a race and also wins. Don't buy more because the stock market has gone up, and don't sell when it's down. In Graham's approach, we have to replace guesswork with discipline. 50% bonds and 50% common stock is a good approach. Any change depends on your attitude, risk appetite, and circumstances of life. If you can take more risk, then go in bonds or cash for a minimum of 25%. If you can't take risk, then have a target of at least 75% in bonds or cash. Change these percentages only as per your life circumstances. Every 6 months, balance them on an easy to remember dates. Bonds. Bonds have low returns and they are secure and stable. Therefore, it's wise to stay away from low quality and high profit bonds. Mostly the bonds that investors focus on are saving bonds. Bonds, along with monthly income, offer cheap and good diversity, which, without any commission, you can reinvest again immediately at the current rate. For most investors, bonds funds are better than individual bonds. Many firms offer many options of bonds funds at a low cost. Common stocks. You can be left without high quality common stocks in your portfolio because they protect against the inflation and also give more returns in coming years. Graham's rules for common stocks. Have common stocks in a right limit, but not excessively diversified, at least 10 and at most 30. Limit yourself to companies with strong financial conditions and that have long records of dividend payments. Limit your price for a new issue around 25 times of their average earnings of past 7 years. Not more than 20 times of the last year. This strategy eliminates strongest and popular companies too. Also all the categories of the growth stocks. A quick explanation for Rule 3. Benefits of your portfolio can be lost if you pay high price for your share. Relatively, big and popular companies are a good option. Read financial statements of any company and don't invest in it without estimating its business value. For a defensive investor, mutual funds is a good option to get the upside of the stock ownership without any downside, where you regularly have to see your portfolio. Here, at a low cost, you can get good diversification and convenience. In this case, to select your stock, you are taking a help of a professional. Whether market goes up or down, you can buy more every week, month, or quarter. Index funds. Best way is to have a portfolio of index funds. Index funds have all the right stocks and bonds. This way you can guess where the market is going. Practically assume that you can save 5,000 per month by having just 3 index funds. 3,000 in stock market, 1,000 where the foreign stocks are held, and 1,000 in bonds. This way, you are having almost every investment of this planet that are beneficial to have. Every month you buy more. If market falls, your already set amount goes further, and you buy more shares than previous month. If market goes up, your money buys less shares. By having your portfolio on an autopilot mode, you avoid losing money in a rising market, which is more dangerous because buying is costly, and refuse to buy in a falling market, which makes investment cheap but increases the risk. On the performance of an index fund portfolio, expecting a 7% average return, which costs 0.3% of portfolio's value, you should expect 6.7% average returns per annum. For low-maintenance stock investing, low-cost index funds are the best tools. No matter how much a good defensive investor justifies, it takes much more efforts to make it better. Because here the risk is high and cost is more. Hold an index fund for 20 years. Add money in it every month. And you can beat professional and individual investors in it. Graham and Warren Buffett both praise index funds a lot. Even during the worst time of the market, some defensive investors enjoy the risk of diversion and selecting individual stocks. This is the power of disciplined buying. In this case, keep 90% of your stock money in index funds. Pick your own stocks in 10%. Never involve your speculative thinking in investing. And don't mix your speculative accounts money with investing accounts money. The enterprising investor. Aggressive investors also start with the same base as defensive investors, and did intelligent analysis proves it right. Then they buy other types of securities also. Remember, in investment program, if you use extra knowledge and cleverness, then you will ruin it rather than better results. Graham gives some points that aggressive investors should never do. High profit bonds, foreign bonds. If you can take more risk, then these will seem more appealing. Day trading, where you hold a stock for a few hours. The more you will trade, the less you will be able to hold. Rather, an enterprising investor should focus on buying these in low markets and selling in high markets. Carefully chosen growth stocks. Don't focus on the growth of the stock when they are going best, but when something goes wrong. Various bargain issues. Temporary unpopularity creates wealth, which allows you to buy a good company at a good price. Some investors may be expert in selecting their stocks. Rest all should take help, especially from index funds. If you pay attention, Graham advises investors to practice first Start off by spending a year in tracking and picking a stock. But not with real money. Test driving in your own way. Before investing real money, you can make mistakes without bearing real losses. Have a discipline and avoid trading. Compare your ways with leading money managers. And learn what is working for you. If you don't enjoy experiments, and your chosen options are poor, then also you won't be harmed. Take an index fund for yourself. And avoid wasting your time in stock picking. If you enjoyed experiments and earned good returns, make a basket of stocks gradually. But keep it limited to 10% of your portfolio. Keep the rest in an index fund. And remember that if you are not interested, and returns are bad, then stop. A last note to become an aggressive investor. Ultimately, financial risk doesn't depend on how your investment is, rather on what type of investor you are. Risk is inside you. If you want to know what is risk, step up to a mirror. That is risk, that you can see in a mirror. Successful investment is to manage the risk, not to avoid it. So friends, we invest because of inflation, which erodes our wealth. An intelligent investor is ready for discipline and learning, controls his emotions, and manages his fear and risk. As soon as the stock price increases, they become more risky, and they are less risky when price falls. When you avoid paying too much for an investment, you reduce chances of losing your wealth. For a defensive investor, 50% bonds and 50% common stocks approach is good. Hold an index fund for 20 or more years. Add money in it every month, and you will perform better. Thank you friends. I hope you liked the video. I hope you could understand some details of intelligent investor. If you haven't subscribed to our channel yet, then immediately subscribe to the channel. And also comment the video. This increases our motivation consistently. If you think this video can help others also, then share it with others also. We'll be back soon with even better videos. Thank you so much.